By now, I'm sure you have digested some of the important ideas. To summarize what we are looking at, we are looking at one of the greatest minds in investment. When we talk about investment, and when we talk about the great books on investment, there are only 3 books that can actually be called classics. Investment classics. And the very first book, which most people will recommend to you, is a book called A Random Walk Down Wall Street. And that is by none other than Burton Malkiel. What we are seeing here is the simplified version of the book. The second classic is Common Sense on Mutual Funds by John Bogle. And the third is The Intelligent Investor by Benjamin Graham. In fact, if you read these 3 books, probably the best thing you can do is read them once a year or once in 2 years. Don't have to read anything else. Probably reading something else will lower your knowledge about investment, not increase it. So we have taken not this book, but a simplified version of this book, where the title is a little different. This is A Random Walk Down Wall Street, and what we are looking at is The Random Walk Guide to Investing, 10 Rules for Financial Success. Now, those of you who have been with me in this journey, we have already finished 4 rules, and today we take a very important rule, that's the 5th rule. Match your asset mix to your investment personality. How to allocate assets. Asset allocation is something that we discuss repeatedly, because asset allocation is simply the greatest ever idea in investing. More than 2000 years ago, somebody called Rabbi Isaac, Rabbi is like a priest, a holy man, in a Jewish holy book called the Talmud, probably presented the earliest known version of asset allocation. And his asset allocation was very, very simple. He said, divide your assets into 3 parts. 1/3 you keep in cash. Those days, of course, there were coins. 1/3 in real estate. He called it land at that time. And 1/3 in your own business. Today, we are lucky to this extent that we can invest in other people's businesses without taking the business risk by investing in stocks or the stock market. Because every time you purchase a stock, what is a stock? A stock is nothing but a tiny piece of ownership interest in an actual business. So Rabbi Isaac had said 1/3 in gold or coins, that time it was the gold standard, 1/3 in land, 1/3 in your own business. Today, it could be 1/3 in something like SB accounts or current accounts or bonds, liquid mutual funds, any short-term mutual funds where you'll get the best risk-reward relationship. Something liquid, something safe, returns are not important there. 1/3 in real estate and 1/3 in the stock market. And this very simple asset allocation came to us not yesterday or today. It came to us more than 2000 years back. And even today, if somebody follows this, not at all a bad asset allocation. There has been research in the US which seeks to ascertain what is the best risk-adjusted return that can be got from a sensible asset allocation policy. And today the version is something like 60% equity and 40% debt would be a very good option. 60% equity, 40% debt. Now 60% equity is a growth avenue. So if we translate this to 60% growth versus 40% income, growth versus income, and this is the allocation. Now let us go to this 2000-year-old wisdom and try to see whether it kind of corresponds with today's very intelligent people or what they are recommending. If you see here, both real estate as well as equity are growth. And this is of course income, cash, whatever it is, liquid. So we are talking about a 33 versus 67% allocation. Not very far, isn't it? Long story short, there's nothing new to learn in either investment or asset allocation across 2 or 3 millennia, not centuries or years or decades. So generally, that is why we tell people, and a lot of people cannot understand. The moment somebody comes to you and says, I have got this great new product, all the possible red lights should light up. There is danger in the new, in investment. That old cliche, I know it's been repeated 1,000 times, so forgive me for repeating it again. Old is gold, most applicable to investment. That's why so many of our people who have gone ahead of us, like parents, grandparents, great-grandparents, without any of these kind of classes, without reading the investment classics, sometimes without much education, they have been able to build up excellent wealth. They have been able to provide wealth sometimes for more than 2 or 3 generations. If at all they have failed, it may be sometimes when they have failed to prepare the next generation to be responsible and handle that wealth, because that next succeeding generation did not work for it. But the clarity of their thinking, the common sense that they used, the way they allocated their assets may not be exactly as per this or exactly as per this, but it was done with common sense, it was done with discipline, it was done across long periods of time. Many people ask, okay, what's the best thing in the last percentage decimal point? Let me tell you one fantastic thing about investment. In investment, there is no such thing as a perfect investment plan. I have never drafted one. I don't know anybody else who has drafted one. There is no such thing as a perfect plan. There are good plans. The beauty of investment is, it is not like your educational institutions. Objective type, 1 question, 4 possibilities. By some inauspicious move, if you tick the wrong thing, 0. Only if that correct thing out of 4 is ticked, you will get your marks. Life is not like that. Investment is definitely not like that. The beauty of investment is that there can be more than one correct answer to an investment question. There can be more than one correct approach to an investment plan. And therefore, if you make an honest attempt at either asset allocation or distributing your assets or a good investment plan, a sensible investment plan, and then you back up that investment plan with a little bit of self-discipline, a little bit of long-term view, a little bit of perseverance, you have to succeed. There is no way you can fail. So, I have not even started because this is a very important rule of Malkiel, so I am just trying to explain our very heading there. I was trying to approach a little bit from this side. Now, all that I have said so far in today's 10 minutes, let me tell you, is not as important as this part of it. What is Malkiel saying? How to allocate your assets? Not difficult. 2000 and odd years back, somebody told us how to allocate your assets. If you want to follow this, this is fine. But there's not much difference here. More or less the same. So how to allocate your assets is very easy, very fine. Now let us look at the main thrust of his fifth rule. And what is that main thrust? Match your asset mix to your investment personality. You can read Benjamin Graham, you can read John Bogle, you can read Burton Malkiel. Again and again and again, you will find one word keeping on coming in their writings. Temperament. Psychologically, behaviorally, personality-wise, do you have what it takes to be a good investor? Investing is very often very, very close to psychology. I have been lucky in many ways. One of the tremendous pieces of luck that I had very early on, even before I had left colleges, at that time there was a facility in Mangalore which I exploited, where free of cost, there were classes in counseling, only one class a week for 2 years. It was on Sunday evenings. And I'm still grateful to those people there. All the faculty there are now no more because this happened 35 years ago. But those 2 years that I spent, don't be fooled by these 2 years. 2 years means only 2-hour sessions once a week. And it can't be 52 classes per year because there would be some holidays here, some there. So maybe about 40 classes into 2 years, so 80 classes of 2 hours each that I underwent in counseling helped me get a foothold into how important it is to look at an investor's behavior, to look at an investor's mind. And that early experience, which I had back in 1982, 83 perhaps, helped me understand when somebody is sitting there that our how to allocate assets, what are the principles of investment, all these things are not very difficult to pick up, they are easy. What is difficult to pick up is investment advising skills. And to pick up investment advising skills when you are with a client, according to me, psychology may be more important than mere investment knowledge. So like I said, I was lucky, but along the way, constantly, even in those years, there was a new body of knowledge developing. And that body of knowledge developing has become today one of the most important bodies, behavioral finance. In the last decade and a half, 2 Nobel Prizes, in the last 15 years, 2 Nobel Prizes have gone to behavioral economists. These are basically guys with their PhDs in psychology, not economics. They have got an additional doctorate in economics. So Daniel Kahneman and Amos Tversky, 2 Israeli psychologists, were awarded the Nobel Prize back in 2003 or 2002, I'm not very sure, but one of those years, 2002 or 2003, Daniel Kahneman and Amos Tversky were awarded the Nobel Prize in behavioral economics in 2002 or 2003, and as recently as last year, 2017, Richard Thaler was awarded the Nobel Prize, once again a behavioral economist. And any book by Richard Thaler you can blindly read because Richard Thaler writes for the common people. So some of the books like Nudge that he has written, excellent books. So the important thing as we enter Burton Malkiel's 5th rule today is how important it is to match your asset mix to your investment personality. Am I very scared? I must focus on reducing the risk in my portfolio. Am I bold? Not whether I think I'm bold. Am I actually bold? That means if risk happens, if something happens to my investment portfolio, I have put in 10 lakh rupees. That 10 lakh rupees is sliding. It's coming to 9.5, 9, 8.5, 8. How do I behave now? When my 10 lakh rupees is going to 11 lakhs, if I say, oh no, I can take risk, 10 lakhs can come to 5 lakhs, I'm not going to be afraid. And if you say, that's fine, the first question I'll ask is, how much did you invest? 10 lakhs. What is the value of your investment now? 11 lakhs. At any point of time between that 10 lakhs becoming 11 lakhs, did it ever drop below 10 lakhs? No. Then I'm sorry, I don't believe you when you tell me that even if my 10 lakhs comes to 5 lakhs, nothing will happen to me. Why? Because we do not know our own ability to take risk. We cannot know our own ability to take risk. The best psychologists in the world can give us very, very good psychometric tests. And we can answer them. But let me tell you, we are sitting there ticking away, answering some questions without the backing of experience. If I've never seen risk in my life or in my investment, and I say that, I'm not afraid of a 50% drop in the market, sorry, I don't believe you. But if you invested 10 lakhs, 10 lakhs came down to 7 lakhs, then you come to your advisor and say, listen, I put this 10 lakhs, it's become 7 lakhs. That means things are available cheap now. Otherwise, my own portfolio would not have fallen. Now when things have become cheap, what do you suggest? Can I put in some more money? Here is a guy who has seen risk, and having experienced risk, he is coming to the advisor and asking, I'm ready to put in more. Now it is established that you have a very high risk-taking capacity, ability. Now it is established. So we should understand that there is only one true test of risk-taking ability, and that is risk itself. How do I believe when my money has actually come down? My brother's money, sister's money, father's money, neighbor's money coming down, going up, irrelevant. I have put money, I have invested something, the value of that investment is now less than what the principal value was, the original value was. What am I doing? Do I panic? How do I behave now? So when you look at this rule, this is what Burton Malkiel is going to discuss in this rule. So with this background, we can proceed with Malkiel's rule number 5. Allocating assets between the 4 recommended avenues of cash, bonds, common stocks, and real estate is important. Malkiel recommends these 4 asset classes: cash, bonds, stocks, real estate. Have something in cash does not mean currency. It could mean from your current account, SB account, to a very, very liquid deposit, to a liquid mutual fund, any of these things, where you can, generally the definition of liquidity is where you can encash something, convert the asset into cash within 24 hours without losing anything. Okay, there's a beautiful definition of equity. Liquidity. The conversion of an asset into cash with minimum loss of time and minimum loss of value. The conversion of an asset into cash with minimum loss of time, minimum loss of value. That's the definition. When we translate it into reality, what does loss of value mean? What does time mean? Loss of value means, ideally, there should be no loss of value at all. If I put in 50,000 rupees into a very liquid avenue, when I take it out, I must get at least 50,000 rupees. Since I wanted great liquidity, I am not worried too much about the returns. But when 50,000 rupees coming to 49,000 rupees, I'll feel very bad about it. So loss of value should not be there when we are talking about liquidity. Loss of time. You go to an SB account, you actually use a withdrawal slip or a bearer check, you can probably walk out of the bank with your currency in about 15-20 minutes. You can draw money from an ATM. in probably 1 minute. But mutual fund, you may not be able to do that, at least not as of now. It may require 1 working day. Generally, when you talk about liquidity on the loss of time front, 1 working day is fine. 1 working day also is considered liquid. Even sometimes a few 2-3 days is also considered liquid enough. So liquidity is very important. That's what he means by cash. Bonds are little longer term debt investments. 3 years, 2 years, 5 years, like a 3-year bank deposit, even the PPF account, which is a very long account, your bond mutual funds, intermediate term mutual funds, short term funds, these kind of things would all come under bonds. Then stocks, of course, the stock market and real estate. Many studies have concluded that the major determinant of overall returns is not the particular avenue of investment chosen, but proper asset allocation. Look at the importance that Malkiel is giving to asset allocation. He is referring to another study, of course. What he's saying is, it's not whether I chose Hindustan Lever or Tata Steel. It's not whether I chose one particular mutual fund or another particular mutual fund. It is how I allocated my assets is the major determinant of overall returns. So asset allocation is extremely important. In the late 1980s, Gary Brinson, a noted money manager and financial analyst, and his colleagues published 2 sophisticated statistical studies of 82 large pension funds. In the US, pension funds would be managing tens, if not hundreds of billions of dollars, and 82 such funds, so a very large sample for study. They concluded that asset allocation accounted for over 90% of the return variability among the funds, with a less than 10% contribution from market timing and actual stock and bond selection. If at all you want to realize the importance of asset allocation, here it is. 90% of the variability in your returns, how your returns would swing at any given point of time, would be accounted for by the asset allocation, and only 10% is whether you chose this stock or that stock, this mutual fund or that mutual fund. So those were relatively unimportant. What was important was the asset allocation. In other words, asset allocation policy was 10 times as important as stock picking and market timing combined. When to buy, what is the level of the market, what is the P ratio, all those fundamental things. All these things put together are only 10%. 90% importance is asset allocation. Market timing and security selection are obviously important. The only problem is that nobody achieves long-term success in the former and almost nobody in the latter. If we were some kind of very reliable fortune tellers, then we could pick the best stocks and the best time, both we could pick. But like he says, nobody achieves long-term success in the former, which is market timing, when to buy, and almost nobody in the latter. Let me give you one example to show you how foolish market timing can be. I think it was 25 April 2003. The Bombay Stock Exchange sensitive index was something like 2,924 points. We had a long recession, and the end of that recession was the worst possible period of the software crash. The technology melted down. Markets had collapsed to 2,924. The drop in the markets was 50% from its peak. And then, just somewhere in January or February, I forget which month, 2004, we are talking about 9 months later, the same index had just hit 6,000. What are we looking at here? You invested a lakh of rupees here, it was 2 lakh rupees. Straight 100% jump in your returns, not even 1 year, 9 or 10 months. Okay, now I started getting calls from clients. Many clients had purchased around this, around 3,000, let's say. Shall we sell? Shall we sell? My simple question to them, why are you getting these calls? Because from here to here we have doubled in value. And now we are reading in the papers that never in the history, at least the recent history of the Indian stock market, has a portfolio doubled in value like this in 9 or 10 months, less than a year. So now that we are making so much of money, shall we sell? My counter to them was, okay, you will sell. Do you need the money? Most of them, no, we don't need the money. I said, equity is a long-term investment. You will sell, you will get cash. What will you do with the cash? No, we will wait for the market to drop. Okay, and when the markets drop, we will buy again. This is market timing. So I told them, I am also an investor. We are not going to sell. We are going to keep. If it is long-term investment, it is long-term investment. These kind of fluctuations, I do agree that the fluctuation is very rare. In a lifetime, you may see this kind of thing only once if you're lucky. I do agree with that. So if you think in the next 1 year or 2 years you need money for something, then definitely sell part of your portfolio. But if you think I do not need, I can't foresee any need for it, and I am aged, let's say 35, and this is part of my retirement saving, and there's another 25 years to go for my retirement, please do not do anything, just continue your investing program whether the index is here or whether the index is here. This was the advice. 1 or 2 people sold, and they sold not because they needed the money. They thought we'll sell here, wait for it to drop. Do you know what happened after that? There was some election or something like that in 2004, I don't know which year it was. The market actually came down a little bit. From that 6,000 levels, it dropped to maybe 5,000 or little less than 5,000. Do you know how many people now made use of that opportunity and bought? 0. You know why? The moment, let's say, 6,000 became 4,800 or 5,000, it started getting a little jittery. Market is, no, it may come down further. Okay, we'll wait for it to come down further, because now the same newspapers who are saying, you should sell, are saying, no, things are serious, things may come down further. And such people who sold at this level, and despite an opportunity presenting itself, did not buy. They missed the boom, the markets went up again, and when the markets went up again, they went all the way to 2008 January, 20,873 points. And these people were still holding the cash, which they had liquidated at this level. So market timing is exceptionally foolish. One of the best examples that I have heard recently about market timing. I'm hungry and I go to a party. I'm late for the party, already seats are occupied, but few seats here, there are vacant. So in most of the parties that I have gone to, when the caterers start serving the snacks, they start from the front row. So I go and sit in the front row. Unfortunately, it's an inauspicious day for me. This particular caterer starts serving from the back row. If that is not bad enough, the number of people attending the party is larger than they expected. It comes forward, I'm waiting, I'm hungry. Just about 1 or 2 rows before they can reach the front row, they run out of snacks. Okay, I missed that. Next, I see them lining up with drinks. Okay, I missed that, let me have at least a soft drink. So what do? Now I know from where they are serving, from the back, I go and sit in the last row. There is one seat there, somehow I sit there. And what do I see? These guys start serving now from the front row. Same problem happens. 1 or 2 rows before my last seat, the soft drinks are over. Now I'm a student of statistics. Now I have to see, once again say, okay, snacks are over, soft drinks are over, but there's still one more line forming that means something else is coming. So this time I have an unbeatable solution. I'll sit in the middle row. Okay, now no way I can let them start from the front, let them start from the back. They have to reach me. Sure enough, they reach me. And the chap is offering something and I can see people putting, so I also put my hand and take up. All I get is a toothpick. Okay, so market timing is something like this. Market timing is like this. You are expecting this thing to happen, that thing to happen. Things don't go the way that you expect. It's a beautiful example of market timing. Okay, so moving ahead, asset allocation is the only factor affecting your investments that you can actually influence. There are very few things that we can control in life and in investment. We should identify that and we should control it. A simple thing in financial planning, something called the emergency fund. How do you allocate assets in an emergency fund? What is an emergency fund? A fund to meet emergencies. And received wisdom would tell you, at least in a country like India, you need to set aside 1 year's normal living expenses to meet emergencies, rounded off to the next higher 1 lakh rupees. So if a normal middle class family requires 60,000 rupees per month of expenses with fees, this, that, 60 into 12 is 7.2 lakhs, round off to the next higher figure, 8 lakhs. 8 lakhs should be the emergency fund. Now, when you apply the principles of asset allocation, which Burton Malkiel is talking about, how do we allocate those assets? This 8 lakhs. Two things are very important here. One is safety. One is liquidity. If an emergency strikes, under any circumstances, my 8 lakhs should not drop less than 8 lakhs, which means this should be put in something very, very safe. So if you put this into something like a liquid fund, liquid mutual fund, or an ultra short bond fund, which are two of the safest among the mutual funds you can come across. So your basic asset allocation is here, but we all know Murphy's law. If things can go wrong, they will. But many times when you're prepared for an emergency, emergencies don't occur. If you're not prepared, they occur at alarming intervals. So what you say is, why should my 8 lakhs rot there for, sometimes people can live for years or decades without an emergency. So what you do is, the mutual funds allow you to give an instruction called the capital appreciation transfer, CAT, by which the income on the mutual fund every month gets transferred to an equity fund. It's not a STP. Let's say this gives you something like 7%, maybe 50,000 a year. After 1 month, your 8 lakhs may have gone to 8.04, 8 lakh 4,000. 8 lakhs will remain intact, 4,000 will go to an equity fund. Next month, if it has gone to 8 lakh 4,500, 4,500 will go here. Next month, if it has gone to 8 lakh 3,750, 3,750 will go to equity. So you are taking a risk in equity for long-term higher returns, but you are taking it with what? Only the income of the principal portion of your mutual fund. This is an example of sensible asset allocation to meet the objective of emergency funding. Okay, so I just wanted to give you that. Asset allocation is the only factor, if you see the last point there, affecting your investments over which you can actually influence. Let's look at this example. Let's see asset allocation and my influence. Where do I start? I start with the most important thing. What is my investment objective? My investment objective is to provide an emergency fund for my family. decision to establish an emergency fund, I can influence. So fine. Second is how much? Well, from what I've consulted, what I've read, in India, I need 1 year. Rounded off to the next higher, 1 lakh. One more thing I can influence, I've got control over this. So I set up my emergency fund, yes. This is what I need, yes. Now I start funding it. You don't have to have the whole 1 lakh to 8 lakhs to start. You can start it slowly. As something matures, as something does this. So I do it. Having done this, I can use this option to get the best out of it. So at any given point of time, if an emergency arises, I know I have this much. This will not come down because it's in the safest avenue. Plus, whatever goes into equity is also part of my emergency fund. I can withdraw that also. So the risk that I have taken, if at all, is not with my principal, it's only with my income. And this is safe. Now, liquidity, this can be withdrawn in 1 working day. Before 3 o'clock, if you do a redemption, generally by 10, 11 or 12 the next morning, the money is directly in your bank account. You can start using it. So this is how we match it. The investment objective, the investments, and the asset allocation that dictates how the investments are to be made, what strategy is to be followed in order to meet the investment objective.